Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. In today's video, I'm going to discuss our April 28th energy update, which explains that although the prolonged mild weather this spring has resulted in a deeper than expected short-term decline, the long-term outlook still favors higher prices. Natural gas is the largest power source for electricity generation. Therefore, its pricing is highly correlated, which is why we focus on natural gas in our reports. In our last report, we said that although natural gas may decline further during this year's spring shoulder period, with supplies ending the winter heating season 10% below the 5-year average, this year's decline would likely be shallow, and the risk of higher prices remains very high. But relatively warm weather across much of the United States in March continued into April, leading to less natural gas being withdrawn from storage than forecasted. And the 10% deficit at the end of March has virtually disappeared, leading to a deeper short-term decline than we anticipated. The recent short-term decline is similar to the last cyclical bull market in 2020. When after its initial rally off its 2020 low, natural gas pulled back sharply before rallying to much higher prices due to a hot summer. And it's not unusual to experience sharp pullbacks during cyclical bull markets. But as we explained in our previous reports, the Trump administration's policies promoting increased production will mitigate the impact of surging electricity demand domestically and exports internationally. But demand is expected to outpace supplies, which supports the observation that when prices were as low as they were in 2024, it always preceded cyclical bull markets that trended higher for at least 2 to 4 years, and it didn't matter who was president at the time. Our view was supported by the EIA's latest short-term energy outlook, in which they said United States natural gas demand, which they calculate as domestic consumption plus exports, will grow by 4% to 116 billion cubic feet per day in 2025. The growth is led by an 18% increase in exports and a 9% increase in residential and commercial consumption. And based on their estimates of increased demand, the EIA expects natural gas to have an average price of $4.30 in 2025, up about $2.10 from 2024. And they expect the average price will increase another 30 cents in 2026 to approximately $4.60. And given the EIA's forecast of where prices will likely average in 2025 and 26, natural gas's recent decline below $3 last week is an excellent long-term buying opportunity. The upside risk is far greater than the downside reward potential. Therefore, we recommend that anyone with agreements expiring within the next 18 months take advantage of the recent short-term decline to reserve natural gas and electricity to be available when your present contracts expire. Now, not every client's risk tolerance and hedging strategy is the same, but hopefully today's report will help you understand your risk-reward opportunities, and we invite you to contact one of our energy analysts to help develop a hedging strategy tailored to your situation. And until my next report, please take care.